Hello again. This video continues on from the first video presentation in the module. We explained in the previous video that accountants keep track of assets, liabilities, and owner equity. And we mentioned that a way to do that would be just to use a sheet of notebook paper and at the top of the page write assets and then liabilities and owner equity. And then as transactions occurred that changed the balances in the asset, liabilities, and owner equity accounts, we could just record those changes in our notebook. Then later, when anyone wanted to know what the assets in the business were and what the equities were, we could refer back to our notebook and find the information for them. Well, this is now our notebook. We've divided the page into two sides, and we have a heading called Assets. We've set up separate columns for the individual assets that we'll want to report on at the end of the accounting period. We have a separate column for cash, one for accounts receivable, this will be explained later, one for office supplies, office equipment, and the computer. We have two liability accounts also, accounts payable and notes payable, and we'll explain the difference between them later on too. The owner's equity is referred to as the owner's capital in the business. Each of these columns represents an account. Let's begin recording business transactions using this form. Here we have the first business transaction that's given in the module example. Our owner begins the business by contributing assets to it. The owner contributes $10,000 of cash to the business along with $500 of supplies. To record this, we'll need to increase assets and specifically increase the cash account by $10,000 and the office supplies account by $500, and then since the owner has contributed these assets, we'll need to increase the owner's equity by $10,500. After doing this, we now have balances in our business accounts. Prior to doing this, there were no assets in the business. If we total up our account balances, we see that we have cash of $10,000, office supplies of $500, so the total assets are $10,500. And that needs to be equal to the total equities. And so far, we only have owner's equity, and it is $10,500. In the second transaction, we again have an event occur that increases owner equity. We earn revenue. And as we explained in the previous video, recording revenue results in an increase in business assets along with an increase in the owner's equity. Remember, the owner gets the revenue from operating the business. We'll need to record an increase in cash and then also record an increase in the owner's equity. And when we're finished, the balance in the cash account will have gone up to $10,200. Office supplies is $500, so we have total assets of $10,700 along with total owner equity of $10,700. Well, we've now completed our first couple of entries, and I hope you're finding this to be a pretty simple process. However, it's time now to stop and warn you about some complications that you're likely to run into depending on the textbook that you happen to be using. Many textbooks use multiple columns for the owner's equity. Instead of one single account, Fred Taw Capital, textbooks often include multiple accounts for the different components of the owner equity. Here we see we have a Fred Taw drawing account, a service revenue account, utilities expense, and rent expense. These are all items that affect owner equity, but rather than record them directly in the capital account, the textbook will record them separately. Here, service revenue is being recorded in its own account, service revenue. We will begin to use these separate accounts in Accounting Lecture 3 concerning the use of debits and credits, but trying to use them here in Module 1 seems to me to be an unnecessary complication, and it distracts you from fully appreciating the major concept here, namely that there are four things that affect owner equity: investments by the owner, withdrawals by the owner, revenues, and expenses. All of these items combined account for the balance in owner equity at the end of the accounting period, and it seems to me to be a better thing for us now to simply record them in one single owner equity account rather than trying to keep track of several. In Module 2, we'll explain why it is that the company will want to use more than a single owner equity account. But for now, just to keep things simple, I think it's much better to work with a single owner equity account. Remember, if your textbook uses corporation accounts, the capital account is referred to as the common stock account, and the drawing account will be called the dividends account. In corporations, stock is issued to stockholders who contribute cash assets to the business. In sole proprietorships, the individual owner makes investments of assets into the business. In corporations, dividends are paid to the stockholders out of the earnings of the company, and in sole proprietorships, the owner withdraws cash from the business. This is referred to as an owner draw. In the second transaction, Fred performs services for a customer. That means Fred has earned revenue. There's an issue in accounting regarding when revenue should be recorded in the business accounts. Under generally accepted accounting principles, we're required to follow accrual basis accounting rules. And under accrual basis accounting, revenues should be recorded when they have been earned. It doesn't matter if we've been paid or not. In this case, Fred did the work and has earned the revenue, so Fred is going to bill the customer. In order to record the revenue, we'll have to increase owner equity by the $500, but then we can't increase cash since the cash hasn't been received yet. However, the customer will be billed and the customer will pay the $500 at some point in the future. We need to record an increase in assets along with this increase in owner equity when we record the revenue. We can't increase cash, but we can increase another asset account called accounts receivable. Accounts receivable represents amounts owed to the business by customers. It's not cash on hand now, but it represents cash that will be collected in the future. In this transaction, Fred has made a withdrawal from the business. Fred has taken cash out of the business, and we're going to need to reduce the cash account by the $1,000. And then, as we know from the previous video, the effect of withdrawal is to reduce assets and to reduce the owner's equity in the business. So we'll reduce the capital account, and now we have $9,200 in cash in the business, $500 in accounts receivable, $500 in office supplies. That's a total of $10,200 in assets, and that is equal to the owner's equity in the business, $10,200. In this transaction, Fred has paid the telephone bill. This is like the utility bill that we talked about in the previous video. We know that paying for a service that's been totally used up represents the payment of a business expense. And expenses are recorded by reducing assets and then reducing owner equity. Remember, Fred gets the revenue from operating the business, but has to also cover the expenses. So we'll reduce cash, and then we'll reduce the owner's equity to record this expense. Another issue in accounting regards the recording of business expenses. When should business expenses be recorded? Under accrual basis accounting rules, expenses should be recorded when the expenses become incurred and the business is obligated to make a payment. We don't have to wait until the cash is paid. So when we receive the utility bill in the mail and then file it away for future payment, we still need to record the expense. So since the expense has been incurred, we'll reduce Fred's capital account by $200. But we can't reduce cash since we haven't paid the bill yet. What we'll do instead is record this business obligation as a liability. We have two different liability accounts to use here. One is called accounts payable and one is called notes payable. In this transaction, the utility company becomes a creditor of the business. We have an obligation to pay for the service that's been consumed. So to record this obligation, we'll increase the accounts payable account. Accounts payable represents a short-term obligation. There is usually no interest charged on these obligations. A note payable is a longer-term loan that does carry an interest rate. So we've now recorded the business expense by reducing owner equity, and then since it hasn't been paid yet, we've recorded our obligation to make the future payment in accounts payable. Here we have another expense that has been incurred. But this expense came from using up office supplies. All assets eventually are consumed, and when they are, they cease being assets and become business expenses. So we need to reduce the office supplies account balance and bring it down to the $450 of supplies that are still left. And then since this is an expense, we'll need to reduce Fred's capital account balance by that $50. We've now recorded 3 expense transactions, and you won't see any other type of expense transaction when you work the problems at the end of the chapter. In the next transaction, we purchased office equipment by making a cash payment to the office equipment provider. We'll need to reduce cash and then record an increase in the office equipment asset account. This is one of those transactions where the composition of the assets has changed, but overall the total assets have not. If total assets don't change, then our total equities won't change either. Therefore, we'll record this event by decreasing cash, increasing office equipment, but will make no change at all in the liability or owner equity accounts.